Hi everyone, and welcome to our webinar on raising capital for later stage companies. My name is Angelo Mazzone and I'm a lawyer in LegalVision's corporate transactions team. And I'm joined today by my colleague and co-host Sophie Mao, who's a practice leader in our corporate transactions team. Welcome Sophie, and thanks for joining. We'd like to start today with an acknowledgement of country. LegalVision acknowledges and pays respect to the past, present and emerging traditional custodians and elders of this nation. In particular, the Gadigal people of the Eora Nation, whose land LegalVision's headquarters is situated on, and the various lands on which those of you are joining us today. Before we begin, a couple of quick housekeeping items. We'll be circulating a copy of this webinar recording following the session. At the end of today's session, and once we've wrapped up the key content, we'll be jumping into a Q&A session. So please do submit any questions that you have in the chat function of the webinar platform, and we'll cover them off at the end. We'd also greatly appreciate any feedback that you have. So after the webinar, please do take some time to complete the feedback survey. And here's an overview of what we'll be covering in today's session. First up, I'll be discussing how to actually prepare for your capital raise with a particular focus on the due diligence or the DD process. Sophie will then be covering how to prepare for or structure your raise. I'll then be running through some of the common deal terms that we see negotiated in later stage funding rounds before Sophie gets stuck into housekeeping following completion of the deal. Lastly, we'll get stuck into our Q&A session. So how do we actually prepare for a later stage funding round? Well, investors in later stage funding rounds and the investors that lead them are usually sophisticated and institutional investors such as VCs, and they're typically contributing quite a significant sum of money. And for this reason, it's likely that they're going to want to conduct DD investigations in respect of the company before they actually invest in it. Now, hopefully this gives the investor a better picture of the company's risk profile, as well as comfort that it's making a sound financial decision. And as we would expect, later stage companies are generally more mature than early stage companies, and over the course of their growth journey, it's likely that they're going to have accrued a lot more information for investors to consider as part of that DD process. And in our experience, we've often seen that the later stage funding documents will contain a term that states that completion of the deal is actually subject to satisfactory completion of the DD process. And from the company's perspective, this means that it's really important to actually prepare for that DD process before it commences so that completion of the deal isn't delayed by the DD process. So that brings us to our next question, which is how do we actually prepare for the DD process? Well, ideally before or while the investor and the company are engaging in preliminary discussions and negotiations, the company should start compiling all of the materials that it intends to include in its data room. And a data room is the virtual location storing all of the materials that the investor will consider as part of the DD process. Now, the list of materials that the company should include in its data room is really extensive, so we're not going to cover off all of them today, but in our experience, having worked with some of the leading VCs across Australia, we have been fortunate enough to become familiar with some of the things that they typically expect to see in the company's data room. And here are some of those things. So the members register, constitution and shareholders agreement, a cap table setting out the company's share capital both before and after completion of the raise, any agreements under which the company can issue options to acquire shares or shares, for example, the employee share option plan, rules and any other convertible instruments like warrants, safe notes and convertible notes, a summary of the company's IP portfolio and any related agreements, employment contracts and key contracts with customers and suppliers. As I mentioned earlier, this certainly isn't an exhaustive list that should of the documents that should be included in the data room. And when we are acting for companies, and to the extent that they don't have these documents in place, we'll obviously assist them in preparing them. I'll now hand over to Sophie to discuss how to structure your deal.
Thanks, Angelo. So one of the first considerations when it comes to your capital raise is how you're actually going to raise money and what the deal structure will be. People will often think about late-stage financings being equity rounds. However, it is still quite common for mature startups to still do bridging rounds using safes or convertible notes. And indeed, many startups might do their final raise leading into a trade sale or an IPO using a convertible instrument that will convert at the exit to avoid the shareholder and pricing complexity involved in doing an equity round close to an exit. With the current economy and the dip in startup valuations, we're finding that actually a lot of our mature startup clients are actually doing convertible rounds at the moment to give them some runway over the next year or two before their next priced round. One of the other types of fundraising structures to consider as part of a later stage financing is venture debt, which can take the form of a term loan, a facility, or a revenue loan. Venture debt isn't really an option that is available for early stage companies because they wouldn't have yet achieved the consistent cash flow required to demonstrate to venture debt lenders that they can service the loan. However, venture debt can be a good option for mature startups, as it may be the case that the higher interest rates and the lender fees is still cheaper than giving away equity, and it limits that upfront dilution, which can be useful, particularly at the moment with the lower valuations that are going around in the market. There are a few considerations to keep in mind in relation to venture debt, including the fact that the lender will likely want to take security over the company's assets to guarantee repayment, which of course does put the company's assets at some risk. Venture debt lenders generally also take a warrant, which is a right to purchase shares in the future at a set valuation, which gives them the ability to participate in any equity upside if the company is doing well. Venture debt interest rates are also generally higher than traditional lending institutions to offset the higher risk of venture debt lending. And also lastly, as a matter of practicality, there aren't as many venture debt lenders in Australia compared to traditional investors and VCs who invest in equity. It is a growing market here, but do keep that in mind in terms of the availability of this type of financing. If you do decide to do a more conventional equity round, one of the other considerations before you raise is the number of shareholders you have and will have after the raise. As the company grows, you might risk getting very close to the 50 shareholder ceiling for private companies. And as a result of that, you might need to consider whether it's appropriate to implement certain structures to manage this, such as rolling your smaller investors into a bare trust structure, where the underlying investors still have the full benefit of their shares. It's just that there's a single corporate trustee recorded on the company's share register. As the number of investors grows, you'll also need to be mindful of distinguishing between the rights of the investors. So in the early days, it might not have been very burdensome to treat all of your investors equally. For example, regularly reporting the same information to all investors at the same times and providing all of your investors with preemptive rights on future capital raises, for example. But as the number of investors grows, all of your investors having the same rights could become an administrative burden and could also be a hindrance to you closing a deal if there are minor investors who are slow and unresponsive. As such, when you're refreshing your shareholders deed at the next raise, it's a really good opportunity to prioritise the rights of major investors and limit the ability for minority investors to slow down or hinder your ability to get things done which are in the best interests of the company. So lastly, one of the considerations that I wanted to talk about as part of structuring your deal, which might also assist in cleaning up the cap table, is whether any of your employee shareholders, early stage investors or founders would want to participate in a secondary sale. If there is high investor interest in your round and the round is oversubscribed, there may be an opportunity for investors to purchase shares off existing shareholders. As a founder, this may be a really good opportunity for you to finally take some cash off the table for yourself after working very hard and making a lot of sacrifices for a long time. But of course, you still need to be mindful of the commercial ramifications involved in this, such as the fact that it's not money that the company is getting, but rather that you're receiving. So you want to make sure that the company can afford that. And you also need to be mindful of the legal restrictions as well. So, for example, you might have enough vested shares that you can sell some, but there might also be other founder lockup or investor co-sell provisions that you need to work around. Secondary sales are becoming quite common in later stage financings that we're seeing. So generally investors are happy to consent to structuring the deal to include a secondary element if the round is oversubscribed and it makes sense for the companies and the founders. I'll now pass back to Angelo to discuss common deal terms.
Thanks, Sophie. And as you touched on, now we're going to be discussing some of the terms that we see most commonly pop up in later stage funding rounds. And one of these terms is what's known as a liquidation preference. A liquidation preference refers to the order in which investors will receive a payout and how that payout's actually calculated if and when a liquidation event occurs. And when we talk about a liquidation event in this context, we're usually referring to a liquidation or winding up of the company, or a sale of all or substantially all of the shares or assets of the company. And as your company grows, it is likely to end up with several different classes of shares, including several different classes or subsets of preference shares. For example, many of the later stage companies that we work with will often have ordinary shares, seed preference shares, Series A, B, C preference shares, and so on. So this means that one of the important things to consider from the company's perspective is if and when they're issuing new preference shares as part of a new capital raise, will those preference shares rank equally with or superior to the existing preference shares on issue? As a matter of principle, a lot of investors, even in later stage funding rounds, will support equal ranking preference shares. So in this sense, all investors would be treated equally. However, we've also seen that some later stage investors can argue that because they're investing proportionally more money than early stage investors on average, that they need greater protection in the event that the company does go into liquidation. And from a founder's perspective, this mightn't be a primary concern because if the company does go under, the founders are unlikely to receive any financial benefit. That being said, it's still a really important thing for them to consider because if the company is going to be issuing new preference shares with superior liquidation preferences to the other shares on issue, then the company will need to get approval or consent from the existing preference shareholders because the new preference shares will be considered to vary the rights attaching to the company's existing preference shares. Another term that we often see heavily negotiated in later stage funding rounds is what's known as an anti-dilution right. Most preference shares in later stage financings will have anti-dilution rights on down rounds. Now, a down round occurs where the company sells shares at a price per share that's actually less than the price paid per share in an earlier capital raise. So, for example, let's say the company undertakes a seed capital raise and issues shares at $1.50 per share. 18 months later, it's ready to undertake its Series A capital raise, and it actually issues shares at a lower share price of $1.30. This would be an example of a down round, seeing as the share price has decreased from the seed round to the Series A round. So the anti-dilution rights that we're talking about are actually designed to protect investors in the event that a down round occurs. And in Australia, anti-dilution rights are almost always calculated on a broad-based weighted average, meaning that if down rounds occur, investors don't get the full adjustment of the lower share price, but something in between the price that they paid and the down round price. And as the company does grow and it undertakes different financing rounds, the founders really need to be mindful of how these anti-dilution rights will interact with other interests that the company has in place. For example, if you're implementing anti-dilution rights on shares issued as part of a new round, you'd need to consider whether the company has any existing warrants or convertible securities on issue that have perhaps an inbuilt discount mechanism in them that could potentially trigger these anti-dilution rights. If so, the anti-dilution clauses in the company's corporate governance documents should actually be structured around this. The last kind of provision that I want to talk about is what's known as a forced exit provision. Sophie and I have seen these provisions becoming more and more common in later stage funding rounds, particularly where the lead investor is a larger fund with a private equity backing or similar. Understandably, these investors can be motivated or quite eager to ensure that the founders are motivated to achieve an exit within a certain time frame. And when we talk about an exit in this context, we're typically referring to an IPO or a sale of all or substantially all of the company's shares or assets. The form of forced exit provisions can really vary. We've seen them as simple as requiring the company to use best or reasonable endeavours to undertake an IPO or an exit within a certain time frame. Or by contrast, they could be something more robust and go as far as actually requiring the company to undertake that exit or IPO within a certain time frame, or based on the recommendation of an advisor or perhaps the availability of a purchaser. The timeframes in which these exit provisions are usually triggered can also vary. However, in our experience, we've found that they're usually triggered between 5 to 7 years from the date of the initial investment. Over to you, Sophie, to discuss housekeeping following completion of the deal.
Yes, so now that the deal is done, it's important to consider the implications of raising a significant amount of money from a corporate governance perspective. So the first matter to consider relates to your financial reporting. Many startups who raise larger later stage rounds in Australia will end up raising from funds who are structured as early stage venture capital limited partnerships, or ESVCLPs. These are a type of fund structure that can be very tax effective and attractive for investors to invest in, but they are also heavily regulated, and some of those regulations can impact the governance of their portfolio companies. In particular, one of the requirements is that if a company's total asset value is more than $12.5 million, they have to have a registered auditor and be preparing audited financial accounts. So if you've raised a large round of money, it's very likely that you'll tip over this asset value and be required to start preparing audited accounts. Getting an auditor can be expensive, but it can also be a great opportunity to mature the company's reporting practices, get its affairs in order, and identify any issues in the company's financial and tax history that can be fixed up to avoid any nasty surprises down the line. The other impact I wanted to talk about as a result of raising a large amount of money can be on the way that your company structures its ESOP offers. So most startups in Australia utilise what's called the startup concessional rules for its ESOP offers in order to enable its employees to receive tax concessions in connection with their equity. One of the requirements under those rules is that an offer of options has to have an exercise price which is at least equal to the market value of the company's ordinary shares at the time of the offer. Most early stage companies will utilise what's called the net tangible assets test in order to determine the market value of its ordinary shares for this purpose, which would allow its employees to pay a very low price for their equity. However, if you've raised more than $10 million in the preceding 12-month period before making new ESOP offers, the company will actually no longer be eligible to use the net tangible assets test for that 12-month period following that raise. So as a consequence, the company will either have to rely on the share price at its most recent raise or get a formal valuation to determine the value of the ordinary shares, or alternatively, be comfortable with having to actually wait 12 months before you make new ESOP offers using the lower net tangible assets test price. If you do decide to continue by using your most recent raise price or obtaining a formal valuation in order to determine the new exercise price, this will likely mean that your employees under the new offers will have to pay more than they otherwise would have under a net tangible assets valuation. However, that's a natural consequence of the company's growth in value, and that is something that the employees in these circumstances will have to be comfortable with. So that concludes the main part of our webinar. We actually have our venture debt handbook available for downloading, so you can download that from the handout panel. We also wanted to let you know about an upcoming event that we have on unfair contract terms, which is being hosted on Tuesday, the 18th of October at 11 a.m. Australian Eastern Daylight Time. And you can register for the event at legalvision.com.au/events. So we'll be answering your questions shortly, and while you submit them via the live chat box, we'll take a minute to tell you about how we can help you with your capital raises and about our special offer. So our team provides end-to-end guidance with capital raises, from term sheet reviews and assistance with transaction documents through to completion processes and signing. After the capital raise, we find that our clients are often wanting to undertake a lot of activities in their business, such as taking on new employees, updating their business contracts. So once you've raised capital, you'll benefit from our membership as you undertake that next stage in your business. For a fixed monthly fee, you not only receive cost certainty, but all-inclusive benefits such as unlimited document reviews, unlimited consultations, meaning you can book in as many meetings with our team as you need to discuss your business's legal needs. And our membership also offers unlimited trademark registrations and much more. So we're offering a free consultation to webinar attendees to learn how we can help you with your capital raising and other business needs. So to book in a complimentary consultation, leave your contact details in the survey that will appear after the webinar ends. Or you can email reply@legalvision.com.au and mention that you watched this webinar. Okay, so we'll answer some of your questions. I believe we had one that was submitted early that Angelo will answer first, and then we'll move on to the ones that came through the live chat box.
Awesome, thanks, Soph. And yeah, the question that's come through prior to the session commencing is, are there any consultants that act as agents for the startups during these later stage funding rounds? So generally speaking, and in our experience, companies are typically represented by their lawyers, who will generally assist the founders in navigating the capital raising life cycle from the outset to completion. For example, when we're acting for companies in these later stage rounds, we're usually engaged from the very beginning of the process to assist with things like the term sheet negotiations, and our role will generally conclude once the deal has wrapped up and we've also attended to any post-completion housekeeping items, many of which were discussed during today's session. That being said, Sophie and I did just act on a Series B raise for a company, and in this situation, the company had actually engaged an investment consultant to provide some guidance more so on the commercial aspects of the raise. So in that situation, we had to work quite closely with the consultancy team to get the deal across the line. And the experience was really collaborative and ran quite smoothly. But something to be mindful from the company's perspective is how this could potentially impact the cost of undertaking the capital raise. So if you're paying not only legal fees but also consultancy fees, obviously the raise is going to cost more. So certainly something to consider.
Thanks, Ange. We might give it another couple of minutes just to see if anyone wants to submit any questions. If we don't get any in, I'm just going to take it that we've done such a great job at answering everyone's questions in advance.
Yeah, one of the most common questions in relation to a point that we discussed today, I suppose, is what's a common liquidation preference? And I suppose while we've got some time, I might delve into that. But usually we see a 1x non-participating liquidation preference being standard, and that just means that preference shareholders would have the right to be paid out of the liquidation proceeds before ordinary shareholders up to the amount of their initial investment. So yeah, that's something that we would usually see as market standard.
Absolutely. And so if you do have any investors that are asking for, 2x liquidation preference or something like that, definitely one to push back on.
Yeah, certainly.
Yeah, so we did have a question that came in saying, what is a typical round of financing where you would see the most secondary sale for early stage investors and employees in Australia. So what I would say is we're actually seeing them very early on. I think this might have something to do with the fact that especially last year there was a really high volume of capital raising and the valuations were really high and there was a lot of investor interest. So we sometimes saw secondary sales happening as early as seed rounds even. And we do see them quite often as part of Series A and Series Bs as well. So we actually see them all the way through. Perhaps they might slow down a little bit this year as there seems to be, a bit of a slowdown in valuation. So there might not be as many rounds that are oversubscribed as there may have been in the last year or two, but we saw them all the way through, including from early stage rounds.
Another question that's come through is what are things to keep in mind or potential issues when a company undertakes multiple safe rounds, if any? So I don't think raising via a safe gives rise to any means of concern. That being said, if the company's just raising via continuously raising via safe rounds, I should say, then it's important to consider, well, how will the safe conversion actually be triggered? Because oftentimes safes will be triggered upon the company undertaking an equity capital raise, perhaps above a certain amount. And if the company is raising via safes, well, then will that safe actually convert? Typically no, because safes don't result in the conversion of other safes. So it might be worth considering whether the safe contains perhaps a maturity date, which, although isn't very common, does impose a time frame by which conversion must occur, and therefore the investor's likely to receive shares as opposed to just having an idle safe just sitting there that's not really converting.
Yeah, and the other thing that I would add to that as well is it is always important, especially if you are raising multiple convertible rounds, to actually model out what the impact of those conversions would be at your later priced rounds. And the reason for that is because often these types of convertible instruments do have discounted price mechanisms, which means that your investors under these convertible instruments will actually get more shares than the value of what they initially put in to compensate them for the risk that they're taking on by making that early stage investment. And so if you do multiple rounds of convertible instruments like safes, sometimes your later safe investors will say things like, well, I don't want to get diluted by your earlier safe investors because that happened long enough ago that that's really a separate round. I shouldn't be diluted by that. And so it's really important to model what happens when all of these instruments convert, because if you take on all of these convertibles, agree to all of these high discounts, then you could end up in a stage where once you get to your priced round, all of those convertible instruments convert in a manner that's actually far more dilutive than you expected when you first signed on to them. So yeah, really important to plan for the future.
Definitely. Another question we've seen come through is how are we seeing early stage investment in the market at the moment in terms of the funds that investors are contributing, valuations and terms. Look, it's no secret that early stage investment has slowed somewhat this year. I mean, our team is still really, really busy. We are finding there has been significant uptake in later stage funding rounds. We've done a lot of Series A, Series B, and even Series C raises, and there is still that early stage investment going on. It's just that it does seem to be leaning more towards the later stage raises. We've certainly seen perhaps a decrease in the volume of safe notes that we've been having to draft, and yeah, the movement has been towards straight equity with a focus on later stage funding. But yeah, there's still certainly investors out there that are willing to invest in early stage funding, so not all hope is lost. Got a question here that asks about the ballpark fees for a capital raise. Now, yeah, the fees for a capital raising assistance really does vary, and it depends on a number of different things, such as the complexity of the raise, how many investors will be participating in the raise, and whether the investors in the company are going to be undertaking protracted negotiations, which would obviously lead to a lengthier capital raising process and therefore a higher price. There are also some additional documents that we as lawyers may need to prepare in capital raising transactions. For example, IP assignment deeds, directors' deeds of indemnity, and whether or not those documents are required will actually depend on the particular transaction in question. For instance, if the investor's appointing a director or has a right to appoint a director to the company's board, then obviously there will be certain additional documents that we as lawyers need to prepare to facilitate that right being exercised. So it is a really difficult question to answer, and it's an answer that we definitely prefer to provide on a case-by-case basis, assessing the landscape of a particular transaction.
We also got a question here around business structures and company structures for companies that are looking to raise capital and whether or not proprietary limited companies are the most common. They certainly are. So for early stage and up to later stage rounds as well, they're nearly always proprietary limited companies. And the reason for that is because public unlisted companies do have additional reporting and regulatory requirements that can be difficult to meet if you are an early stage business. And so there's no need to put yourself through that additional cost and expense if you don't need to. And the other reason is alternative structures like trust structures, unit trusts, family trusts that you might see more commonly for small businesses that are less capital intensive. If you are a company that is looking to raise capital, a lot of investors, their investment mandate will only allow them to invest in companies and not other types of structures like trusts. And so for that reason, I would say nearly all of the companies that we raise capital for and that we see our investor clients invest in are private companies.
Another question that's come through is, with the drop in current valuations, what's the market discount for convertible notes at the moment, and what have you observed? Yeah, we haven't seen the market standard discount rate move all too much, if at all. We've got a number of clients at the moment that we're working with in preparing and drafting convertible notes, and that discount rate is most commonly at around 10 to 30%, most commonly 20% is considered widely as being the market standard. So yeah, we haven't seen an impact on that as of yet.
Yeah, something that I would add to that as well is with convertible notes and safes, the other type of discount mechanism that we'll see is a cap on the valuation, so a valuation cap. Something that we're seeing a little bit at the moment with the current market is there are quite a number of companies that are doing flat rounds or rounds where their valuation has only increased slightly from their last round. And so with convertible instruments, we are sometimes seeing companies having to accept a valuation cap that might actually just be the same valuation as their last round, as opposed to a higher estimate of what their valuation might be. So that is a bit unfortunate because that does mean that hopefully at your next round that is at a higher valuation, you would have had to accept a lower valuation cap and a greater discount. But yeah, that is something that we are seeing a little bit at the moment. There was one question here around the type of investors that are investing at the moment and whether there's a change in the profile of investors that are willing to invest or not. I wouldn't necessarily say that that is the case. I feel like actually at the beginning of COVID a couple of years ago, a lot of angels and high net worth stopped investing for a while and got a little bit nervous, and we had some really early stage rounds with high net worths that fell over. But I would say at the moment the profile of investors investing hasn't really changed that much. As Angelo mentioned, I would say what we're seeing more might just be the type of companies that are receiving investment. A lot of investors are, backing their existing portfolio companies, which is why there's, more later stage rounds as opposed to, first round early stage investments, because a lot of investors are wanting to prioritize supporting their existing investments rather than taking the risk on a new company that is just starting out. But yeah, in terms of that those later stage investings with existing investors, we're still seeing, you know, the whole range and type of investors investing in those.
One of the questions that's come through is how early do we start engaging with early stage startups and in what capacity? Well, as a firm, LegalVision, you know, obviously tailors to early stage startups and companies across the spectrum of the growth phase, I suppose. But yeah, we work with a lot of companies from day dot, whether that be in assisting with employment agreements or intellectual property. And in terms of capital raising, we obviously come in a little bit later when the company's ready to start taking on investors and raising capital. But yeah, we do, you know, work with companies in, you know, quite small rounds all the way from to later stage companies working with quite a large sum of money, and they're really looking to scale and could be looking to scale internationally. So I guess in answering that question, I would say that we work with very early stage startups, and we get involved whenever the business really needs us to get involved, and that could be in any capacity, not just in capital raising. Obviously, LegalVision, you know, prides itself in being a one-stop shop, and we do offer more than just corporate transactions and capital raising assistance at the firm. So.
Yeah, we do have a lot of clients where we might do their first capital raise, and as a result of that, they really want to, you know, get all their affairs in order now that they can afford to do so. And so we, you know, our whole practice will help them get their, you know, employment and HR processes in order, business contracts, IP registrations. And so that's something that we do quite commonly as well, is do the first capital raise and then assist them with getting all of their legal processes that they need in order to run their business.
Awesome. I think that covers all of the questions we've received so far. So we may be able to wrap up a little bit early unless there's any others that are trickling through, and we can let you get back to your day.
Wonderful. That's all then. Don't forget to request your free consultation via the survey as well. So if you do have any questions that you think of after the webinar is complete, definitely book that in so you can have a chat to us. Thanks so much for joining us.
Thanks, guys.